What if inflation never goes back down? Prices go up and never seem to come back down. Even when headlines say inflation's cooling, your grocery bill doesn't. A chocolate bar that cost 30 cents in the 1980s now sells for over $1. Fries that were 50 cents? A few dollars today. So here's the unsettling question. What if this never ends? What if rising prices aren't a glitch in the system, but the system itself? Would wages keep up? Or would life quietly get harder every year? Let's find out what happens when inflation refuses to fade, why it's so hard to control, and what it means for all of us. But to understand where this starts, we need to ask, why do we even need inflation in the first place? Chapter 1. Why a little inflation is good. Zero inflation sounds peaceful, prices frozen, predictable, but that peace would kill the economy. If everything stopped moving, the economy would too. Money must keep circulating because one person's spending is another's income. With no price growth, companies stop investing because profits stall and customers hold back, waiting for lower prices. As demand weakens, production slows to avoid unsold goods, hiring freezes as work dries up, and the economy grinds to a halt. A touch of inflation keeps money alive. When people expect prices to rise just a little, they buy now instead of waiting, fueling growth, business, and jobs. Too little, and the system seizes up. And what follows is something far worse: deflation. Chapter 2. The danger of deflation. Deflation feels like a blessing until it crushes you. It's when prices keep falling and money gains value, a downward spiral that feeds on itself. When Japan's housing and stock bubble burst in 1991, property and stock values collapsed while debts stayed the same. People stopped spending to repay loans, businesses cut prices to attract buyers, and as consumers waited for things to get even cheaper, demand fell further. Profits shrank, wages were cut, and jobs disappeared, trapping Japan in years of deflation. That spiral lasted nearly 2 decades, Japan's lost decades. It proved that once deflation takes hold, it's almost impossible to escape. Deflation shows what happens when prices fall, but what about when they rise and never drop? Chapter 3. Why inflation sometimes won't fall. When central banks raise interest rates, they're trying to slow demand for goods and services before it overheats the system. But inflation doesn't always listen. Sometimes it stalls, sometimes it fights back, driven by forces far bigger than interest rates alone. Let's break it down. Number 1. Persistent demand. Demand pull inflation. When people still have savings left over from stimulus checks, wage growth, or strong job markets, they keep spending. Restaurants stay full. Flights sell out. Online orders keep coming. Businesses can't expand production overnight. Factories, labor, and logistics take time. So when demand outpaces supply, prices rise to ration what's available because higher prices push some buyers to hold back, easing pressure until supply catches up. That's demand pull inflation. When prices rise because demand is stronger than supply, too much money chasing too few goods. Central banks fight back by raising interest rates, making borrowing costlier, to slow demand and bring inflation down. But the effect takes time to bite. Because many households still have savings or fixed costs, it takes months before higher interest rates slow demand. That's why prices often stay high even as interest rates rise. Number 2. Supply shocks. Cost push inflation. Sometimes the shock comes from the supply side, not from people buying too much, but from the world producing too little. In 1973, the Organization of the Petroleum Exporting Countries, OPEC, cut oil exports to many countries during the Yom Kippur War, triggering a global oil shock. Oil prices quadrupled as shortages hit and demand stayed high. Fuel costs surged, shipping costs soared, and grocery prices followed, since transporting food became far more expensive. Factories couldn't run cheaply anymore, since they relied on oil for power and transport, and growth collapsed. That deadly mix, inflation plus stagnation, became stagflation, when prices rise even as the economy slows, meaning businesses shrink, jobs disappear, and production falls. Then, decades later, Russia and Ukraine, key global suppliers of energy, wheat, and fertilizer, were thrown into turmoil by the 2022 conflict. Fighting damaged ports and transport links, while sanctions on finance, energy, and trade limited access to global markets. With shipping slowed by Black Sea risks, supplies of vital goods fell, sending fuel and food prices soaring and straining global supply chains once again. Here's the trap. When supply finally recovers, prices rarely roll back. By then, companies have rewritten contracts, raised wages, and adjusted their pricing models. Once the system resets around higher input costs, the old, cheap prices vanish for good. Trade barriers and tariffs can have a similar effect. raising import costs and fueling inflation. In 2025, new U.S. tariffs on imports, especially from China, Canada, and Mexico, increased costs for businesses, which passed them on to consumers through higher prices on everyday goods. Number 3. Wage price loops, built-in inflation. Now, imagine this. Prices rise, so workers demand higher pay to survive. Firms raise wages, but higher payrolls mean higher costs. So those same firms lift prices again to protect margins. That's a wage price loop. The longer it runs, the deeper it embeds itself in everyday life. Suppliers preemptively increase prices, raising them in advance because they expect their own costs to rise soon. Inflation stops being a shock, it becomes a habit. And habits are hard to break. Number 4. Expectations, the psychology of inflation. Here's the invisible layer most people miss: belief. Inflation is partly numbers, but mostly confidence. If consumers and businesses believe prices will keep climbing, they act in ways that make it true. People rush to buy before things get costlier, pushing demand up. Workers demand higher wages just in case. Businesses lift prices just to stay ahead. Economists call this unanchored expectations. Once that anchor breaks, no policy move feels strong enough because psychology multiplies every shock. The result: sticky inflation. When all four collide, high demand, weak supply, wage loops, and runaway expectations, you get sticky inflation. Prices stop accelerating, but they don't fall. As inflation lingers, everyone adjusts. Workers push for higher pay, businesses lift prices to protect margins, governments stretch budgets. The whole economy shifts upward. That's why you can't simply reverse inflation. It's like trying to push a beach ball underwater. The pressure keeps forcing it back up. Sticky inflation isn't just stubborn, it's structural. It's built into our expectations, baked into our wages, and woven through our supply chains. It fades slowly because those forces adjust over time, not overnight. Every part of the system has to cool together. If one stays hot, it feeds the rest and inflation sticks around. When you hear inflation is falling, it just means prices are rising more slowly, not that they're dropping. Chapter 4: When inflation explodes, hyperinflation. When inflation breaks free, it mutates into hyperinflation. Zimbabwe experienced it in the late 2000s. Hyperinflation is when prices skyrocket and money rapidly loses its value. The government printed money to pay its debts, but goods vanished faster than cash appeared. Prices doubled daily. A loaf of bread cost billions. People pushed wheelbarrows of money through the streets until the money itself died. Banknotes flew through the air like confetti, worthless paper reminders of broken trust. It's what happens when the very value of money evaporates. To stop chaos like that, governments reach for their sharpest tools. Chapter 5: How governments fight back. When inflation roars, central banks reach for their bluntest weapon: interest rates. Higher interest rates make borrowing expensive: mortgages, car loans, business credit. Spending slows. Demand cools. But interest rates aren't the only tool. Central banks can also use quantitative tightening or QT, selling the government bonds they once bought during easy money years. They sell these bonds to banks, financial institutions, and investors in the open market, pulling money out of circulation. Less money, less heat, less inflation. Governments can also tighten through fiscal policy, cutting spending on public projects and services or raising taxes, giving people less money to spend, which cools demand for goods and services, but comes with pain. These tools take months to work and often come with side effects: slower economic growth, layoffs, sometimes recessions. It's like giving the economy strong medicine, bitter but necessary. Inside every central bank, there's a constant debate. Hawks push to crush inflation fast, even if it means slowing economic growth. Doves prefer patience, fearing that fighting inflation too aggressively could trigger a deeper economic slump. Finding the balance between them, not too harsh, not too soft, is one of economics' hardest acts. And when essentials like fuel or bread surge, governments sometimes impose price caps to calm the storm. They help temporarily, but if held too long, producers lose profit, cut supply, and shelves go empty. Short-term relief, long-term pain. It buys calm today at the cost of chaos tomorrow. Chapter 6: How inflation is measured. All these policies sound powerful, but do they actually work? And how do they affect what we pay every day? The answer lies in how we measure inflation. Inflation isn't one number, it's a snapshot of how prices change across daily life. The Consumer Price Index, CPI, a measure of inflation, tracks a basket of goods: food, rent, transport, clothes, showing how much prices rise or fall each month. But food and energy prices swing wildly with weather, wars, and other short-term shocks. So economists also use core inflation, a steadier measure that leaves those out to reveal the underlying trend. It captures most prices, just not the volatile ones, showing whether inflation is truly easing or still building underneath. These numbers guide central banks when setting interest rates and shape how much our paychecks are really worth. It's why people say, "I'm making more than ever, but it feels like less." We can measure inflation's effects, but its causes are sometimes less innocent. Chapter 7: Companies and Greedflation. Not all inflation comes from costs, some comes from choices. When supply costs rise, businesses lift prices to survive. But some kept raising them even after supply costs fell. Economists track this through the Producer Price Index, PPI, which is what companies pay for materials. Normally, when PPI drops, consumer prices, CPI, soon follow. But in 2022 and 2023, producer prices cooled while consumer prices stayed hot. That gap revealed something else: profit-driven inflation, or greedflation. Energy and food giants like ExxonMobil and Shell posted record profits while families paid record bills. The cure? Competition, transparency, and regulation to keep markets honest when crisis turns into opportunity. After a while, you stop asking why prices rise and start wondering if they'll ever fall again. Chapter 8: If inflation never falls. Imagine a world where prices keep climbing year after year. Living costs outrun wages. Savings lose value unless invested. Loans and mortgages stay painfully expensive because central banks can't cut interest rates without reigniting inflation. High interest rates slow demand for goods and services, but squeeze the budget of families as debt piles get heavier and fixed incomes fall behind. It's a double bind: rising prices and rising borrowing costs, two jaws closing at once. If this really is our future, if prices never stop rising, how do we survive it? Chapter 9: Surviving a high inflation world. If inflation becomes the new normal, survival means adaptation. Invest in assets that outpace inflation, such as index funds, real estate, gold, or inflation-linked bonds. Index funds track the stock market's growth over time, while bonds pay interest on money you lend to governments or companies. Steadier, lower-risk assets that can preserve value. And upgrade your skills, as job mobility, moving to better-paying roles or industries, beats small annual raises. Add a weekend gig or side business to build extra income. Cut non-essentials. Save aggressively. And fix your debt rates, meaning lock in fixed-interest loans or mortgages so rising rates won't make your payments jump. Don't just work for money. Make your money work for you. Economies adjust. Technology advances. Supply catches up. Competition brings prices back in line. Central banks push and pull to keep the balance of inflation, a constant tightrope. Too soft and prices spiral. Too hard and economic growth dies. If inflation lingers, it reshapes how we work, save, and dream. A little keeps the economy alive. Too much erodes faith in money itself. That's why central banks chase that fragile 2% target of inflation. Just enough heat to run the engine, not enough to burn it out. Because once inflation moves in, it never leaves quietly. Thank you for watching, and subscribe for more videos like this.